Okay, so this is video 2 for chapter 2 for investments. So we're going to talk about yield on different instruments and how that can be affected by different parts of the calculation, and just show kind of different yields that we can calculate. So different factors that influence our quoted yields: the par value versus the investment value, the 360 versus 365 days, or 366 if it's a leap year, simple versus compound interest, also discounted, it doesn't label it here, but discounted versus full price, or paying full price for something and having interest paid on top of that versus buying at a discounted price, also affects our yield. So a bond equivalent yield we can't compare directly to a T-bill because it's 360 versus 365, and the return is figured based on par versus price paid. And this goes back to discounts too. That we need to adjust the bank discount rate to make it comparable. So an example of a bond equivalent yield, we have P as being the price of the T-bill, N being the number of days of maturity, and obviously this 10,000 would be representing the par value of the T-bill. So the rate that it pays according to the face amount, the stated rate in this case is 5%. But if we do the math, we'll see that it is 5.13%. And I'll show you in Excel that they did a little bit of rounding here on their calculation. But if I take my 90 days, 365-day year, my $10,000 par, my stated interest rate of 5%, my non-discounted interest, all I did was take my 90 divided by 365, multiply that by 10,000, or take 10,000 times 5% and multiply that by 90 divided by 365, and I got 123.29. The book and the PowerPoint show that as a full $125 difference. It's $98.75, but the more exact calculation is the one that I just did at 123.29. So you can see I can come up with, it is higher than 5%, just like the book says. This number is just 10,000 minus the non-discounted interest. The bond yield, I'm figuring exactly like they showed the calculation that we just did. But just to show you that the only difference between my calculation and theirs is that they kind of rounded their number and I didn't. If I take the full 125 discounted rate interest, I get the 5.13% bond equivalent yield that they stated. They're just taking this as a flat number rather than actually calculating, whereas I calculated what the discount would be at the given rate for the time frame. Okay. Back to the PowerPoint. Whoops. So you can see this is where we match up at 5.13%. So an effective annual yield. You take the price of the T-bill, and N is the number of days. So we have our par value minus the price of the T-bill divided by the price of the T-bill. So 1 plus par value minus price divided by price, 365 divided by N, all minus 1. So when I do that calculation, it comes out to 5.23. And again, I did this in Excel, and again, they rounded it. So my calculation, I had a yield of 5.16 because I didn't use the full 125, but if I used the full 125, it comes to 5.23 as they showed. Figure the interest all the same, and then this, I just basically put in the calculation they showed there on that slide. Okay, so now we can compare. We got the effective annual yield versus the stated rate, the bond discount rate, versus the effective annual yield. You notice they're all different. Okay, so different ways that we measure our instrument yields and different methods we have to use. And there's also another one we're going to talk about in a little bit regarding the fact that there's tax differentials between certain investment securities as well. Okay, so moving on to fixed income and capital markets. Capital market, fixed income instruments. Fixed income, we're talking about a regular payment, generally speaking. Usually more popular with people who want to receive regular payments from their investments. The government issues treasury bonds and notes. We have bonds and notes. We have different denominations of them. And we have different types of interest on it. And we need to talk about the differences in how the risk in them, and also what the interest type is. So denominations, both bonds and notes, are usually in increments of 100, but they're far more commonly in increments of 1,000. The interest payments on a bond are called coupon payments. You're receiving just the interest itself until the end, and then you receive the par value, whereas generally notes, you're receiving P and I, principal and interest, as it goes. So that's a big difference between the interest and the interest type. The interest type is typically a fixed amount on a bond, because you're getting a coupon rate that stays constant throughout the life of the bond. For most bonds, there are types of bonds that just change, flexible ones. As far as risk goes, there's not too much risk when it comes to treasury bonds because of the fact that it's backed by the treasury. There's very little risk, which means they usually yield a pretty low interest rate. Yeah, so move on from there. So this is a listing of treasury bonds from your book. It talks about what the bid price is, what the asking price is, and what the change is, and the yield to maturity. This is from the Wall Street Journal from April 18th, 2017. And agency issues with the federal government. Most home mortgages are related to FNMA, that's Fannie Mae, and the Federal Housing Commission and federal home loans, and all these have a very high amount of loans and lending within them. The risk of these securities it's implied that it's backed by the government, but and in September 2008, the federal government did take over Fannie Mae and the Federal Home Loan Mortgage Corporation, which is FHLMC. Municipal bonds. Municipal bonds, it says issuer. The issuer of municipal bond is the local city or county, a more local individual, state and local governments. They differ from presidency agencies because they are usually for either revenue or for a particular project. That's the GO versus a revenue. So a GO is a excuse me 1 second. Okay, sorry about that. I misspoke. My note was unclear on my thing here. So GO is a general obligation bond that's backed by the full faith and credit of the issuer. So that means that it's just basically a bond for the city or local municipality to continue operations. It's kind of a general, I would say it's general operations pretty much. Then a revenue bond is issued to finance particular projects. So this would be what you see if they build schools or build other things around the municipality. And then there's also industrial development bonds, which are issued to help finance commercial enterprises. So say they're trying to attract a, Google or somewhere's looking for a new headquarters, or Amazon, or a new facility to put in. They can use industrial development bonds to aid in paying for some of that commercial development, because it brings jobs and things like that is the whole purpose behind that. As far as taxation goes, municipal bonds are taxed at the state level usually, or local level, but generally speaking, they are tax exempt at the federal level, which means when we figure out the yield on these bonds, we need to take into account the fact that it's not taxed. So when we're comparing one to another, we're comparing our corporate bonds or other bonds to a municipal bond, we need to take into account the fact that there is a different level of tax, because that changes what the true yield of the instrument is. So this is the calculation to figure out the yield of that instrument. And I'm going to stop this video here because I'm trying to make my videos a little bit shorter, and then I will continue with figuring out the tax difference on the next video.